What is going on, investors? Hopefully, you guys are doing well out there. Time to talk about Adobe, and there is so much to talk about when it comes to this company. They reported their Q3 earnings before the bell today. We were actually expecting them after the bell. They also gave guidance for the upcoming fourth quarter, but obviously the gigantic news was the fact that they decided to buy a company called Figma for over 20 billion. Yeah, that's 20 billion with a B in cash. And this comes from a company, which in reference to Adobe, that has a market cap under 200 billion. In fact, I see here about $173 billion. This is a gigantic acquisition, not only from a dollar perspective, but the fact that Adobe is just a $173 billion. If this acquisition works out like management is expecting it to, well, I tell you what, Adobe's going to get a heck of a lot bigger in the coming years ahead. If this acquisition is a flop, this is going to set this company back big time, because we'll talk about the acquisition when it comes to the financials. We'll take a look at the structure of the deal. We'll take a look at cash flows and the balance sheet over at Adobe and see that this is an incredibly rich deal for this company. We'll also look at Figma. We'll look at a little bit of their business model, but we'll look at some of the stats that they gave us of this company, and we'll show you that this company better grow quite a bit, or Adobe paid a steep multiple in a marketplace where multiples just, quite frankly, have been falling off a cliff. Now, speaking of falling off a cliff, that's what Adobe stock did today. We'll come over here and look at it from a technical perspective. It's actually setting up quite nicely from a technical perspective. So we'll talk about all of the things that we see there. Now, Adobe year to date down 45%. That's on the heels of being down over 16.7% today. That was over $62. Clearly, investors were not pleased at all with spending over $20 billion. I read through the conference call. There was an analyst question saying, hey, Adobe, you've been so prudent over the years with your cash flows and your cash and your acquisitions, and then you all of a sudden paid like 50 times sales, not 50 times earnings, 50 times sales for a company that is incredibly rich in today's marketplace. I don't need to tell anybody that. Now, let's go over the earnings really quick. Then we'll get on to the deal, and then we'll look at the financials from a little bit closer perspective. Revenue in the most recent quarter coming in at $4.43 billion, That was 12.7% year over year growth. That did miss expectations by about 10 million. I think the stocks, minus the deal being announced, I think the stock would have sold off. Wouldn't have sold off by 16%, but the stock would have sold off because the revenue came underneath expectations. What also coming in underneath expectation was that Q4 guidance. Total revenue, $4.52 billion. Now, expectations, though, were for a revenue number closer to $4.6 billion. So not only did we miss the revenue mark in the most recent quarter, and we have a decent growth rate on this one, but just factor in inflation is 7, 8, 9%. So the fact that you're growing your revenues 12.7%, not necessarily that much far and above over inflation numbers, you missed expectations there, but you're also missing expectations for the consensus revenue estimates for the upcoming quarter. Now, when we start to zoom forward with Adobe, we see essentially what Wall Street is pegging for a lot of the stocks that we're looking at is a mid-teens grower for the foreseeable future. In fact, it kind of shrinks as you get into fiscal year 2024. You kind of get to a low double-digit grower. That's not necessarily going to impress Wall Street from a multiple perspective. And now you layer on top of that the fact that you just paid 50 times sales for Figma, which the overarching feeling when I listen to analysts and analysis of this deal is this company straight overpaid for this company. And it could, for some investors and some analysts, it almost looks like a sign of desperation by Adobe having to overpay for a company in a market that a lot of people think is going to continue to go down 10, 15, 20%, or maybe even more in the coming months ahead as the Federal Reserve obviously continues to tighten quantitatively and interest rates heading upwards. The deal is for $20 billion in cash. They say cash here, although I do see that it's actually half cash. So you're looking at roughly $10 billion. And then you're looking at about half of stock. And that's also kind of a worrisome frustrating thing for most investors is the fact you're going to get diluted by over $10 billion, which again, on a company that is worth about $173 billion. So that's pretty significant. Although when you read through management conference calls, obviously they're going to buy back the shares over at Adobe to a certain degree as well in the coming quarters. So you're going to offset that dilution just a little bit. But clearly, investors not excited about this most recent deal. Now, we talked about how Figma was a $400 million company after the fiscal year 2022. Again, that is a 50-fold multiple because they paid $20 billion for this company. The news from Adobe is the fact that this company is not going to be profitable for several years. So this is actually going to hurt Adobe's EPS and their operating profits and their profitability for the next several years. Now, we will be able to layer on $400 million worth of revenue, which look, at Adobe is somewhat significant. This company did just $4.4 billion worth of revenue. So another 100 million or so in revenue per quarter is almost a rounding error, quite frankly. But Adobe's argument is the fact that this company is growing tremendously, has similar type gross margins, just massive, like 90% of gross margins. They do have positive operating cash flows. This is likely due to some kind of stock-based compensation that they had inside of Figma. Their operating cash flows are likely positive because they're compensating a wide amount of their employees with some kind of internal stock that the company has. They claim that the total addressable market is $16.5 billion. Obviously, Figma is not going to capture all of that, but if they can capture even 25, 30, 40% of that, clearly a $20 billion mark. Obviously, Adobe is banking on them capturing a large portion of that. Now, these acquisitions are always a little complicated. If you followed Adobe over any length of time, this is a company that has made acquisitions in the past and sometimes kind of folded those acquisitions later. Also, when you're talking about a company like Figma, which really existed in a lot of ways because a lot of people were sick of Adobe products, the fact that they are going to now roll in this product with Adobe could complicate the situations. Now, there may not necessarily be a lot of other competition out there. And so users of Figma or potential users of this software stack really don't have another choice, but that's also a risk going forward, is that Adobe just simply cannot integrate this well enough into the system. Also, when you come over here and look at pricing, the high-end prices is about $45 per editor per month. The middle tier, which is typically where when you have this kind of three-tiered system, they're looking for you to sign up in this middle tier. Now, there is an enterprise version of this software as well. No word from Adobe. They got pressed multiple times in the conference call. Obviously, Adobe has its own software stack. It has its own Creative Cloud, which is kind of a one-time membership, all-inclusive membership is probably a better way to describe it. No word whether or not they would just roll Figma into the Creative Cloud software or if they'll keep this as kind of separate pricing and a separate company. We'll see what the company decides to do later on down the road. But this is an extraordinarily high risk, but likely a high reward type of maneuver by Adobe. Again, and that is why you saw a lot of investors just peel out of this stock, because all of a sudden we have dilution risk with this stock. We also have the risk that this deal doesn't get integrated very well. And also there's the risk that Figma just simply doesn't live up to the total addressable market estimates and the growth rate that is achieved over the last couple years. So much more risk on Adobe based on paying just in my opinion, just a ridiculous multiple for a stock in this market. Now, a year ago, 2 years ago, a multiple on that type of software product might not have been as crazy, but everybody's multiple has started to come back, and it's clearly a steep price to pay, and the market didn't like it. Now, let's still analyze this company from the way it sits right now. Again, we're going to bolt on if we believe these these numbers, and there's no reason not to. We're going to have a $400 million worth of annual recurring revenue over at Figma. My guess is they have a gigantic growth rate. In fact, you see evidence of it here in the most recent fiscal quarter. They're going to grow about $200 million. That's essentially doubling their business, because it looks like if you add $200 million worth of business and you get to $400 million worth of business, that means last year you were sitting right at $200 million. If they can continue to double this, and that's obviously the big question mark that investors are going to wonder if this is going to be possible. Well, next year, you're almost $1 billion company. You're still paying, even if we double this $400 million, next year, you're still going to be paying over a 25 forward sales multiple on this. But then if you double it again, you start getting to a $1.6 billion run rate on that revenue, and then so on. So obviously, you have to have this acquisition work out very, very nicely. And in fact, the revenues probably have to continue to double or come very close to that over the coming years for that acquisition to make sense from a multiple perspective. Because when we see this company, it has $4.43 billion worth of revenue, very consistent revenue company. You see over the last 9 months, you had $13 billion worth of revenue. We talked about how the upcoming Q4, you're expecting about $4.5 billion worth of revenue. So for the full year, you're going to have about $17.5 billion worth of revenue over at Adobe for 12 months. They just bought a company for $20 billion. So they literally paid over 1 year's of revenue, not profits, revenue for a company. This is a high risk, high reward maneuver by this management, which again, analysts pointed out on the conference call, have never done this type of thing in this company's history. So it's either an act of desperation or it's an act of something that is going to transform Adobe. I really think it is going to be on the knife's edge with Adobe. Either this is going to be turning into like a Microsoft Junior. It's not going to get to Microsoft size. I don't want anybody to think about that, but this is going to be a step below Microsoft in terms of revenue, profits, and market cap. Or this company is going to be in some deep trouble, quite frankly, from a perspective of revenues. Because we notice in the most recent quarter, $4.4 billion worth of revenue, about $540 million worth of cost. Again, expect these costs to rise in excess of our revenue growth for the subsequent quarter. When I showed you these earnings estimates, or excuse me, these revenue estimates for the upcoming quarters, these are actually probably a little low by about 100 million, maybe even as high as $200 million for the subsequent quarters, depending on how far you go out. So the revenue growth rate should actually maintain where it's at. It actually should get a little bit better since you're comping against a company that is about to bolt on another at least $100 million worth of revenue. And again, if they grow that quite a bit next year, it'll be even bigger than that. What's going to get hurt is the fact that our EPS is likely going to shrivel up, because we're going to have a massive amount of dilution that will naturally make your EPS go down. And then on top of that, we're bolting on a company that is not profitable from an EPS perspective. So these EPS estimates are way off. These are going to go down, and my guess is you're going to go down to kind of single digit, maybe even negative growth from that earnings side. And so that's certainly going to hurt the company from a certain perspective with some investors. Now, we had that $4.4 billion worth of revenue. Total cost on that, we love this company because they have those 90% software margins, okay? About 10%, shade over 10% of revenue just goes to the cost of revenue. So just $546 million worth of cost. So you have gross profit sitting at $3.9 billion. Last year, you're about $3.5 billion. For the full year, 11.5. So much of this company's revenue flows down to gross profit. Now, we do have other operating expenses. For the full quarter, they came in at $2.4 billion. That was $400 million more than where you were the previous period on this one. Now, for the 9 months period, similar type story, but we see in the most recent quarter, our operating expenses kind of accelerated, and that really chewed up our operating income. Notice year over year, essentially flat on operating income, 1.4 million up to just under $1.5 billion. You notice for the full year, you're looking at about $4.6 billion worth of operating income. Go ahead and bolt on another $1.5 billion, and you're at $6 billion worth of operating income on this company. And again, they just pulled off an acquisition for $20 billion. This is a company that just paid over 3 years, actually more than 3 years forward operating incomes for a company. Again, this is why this company went down. There are some investors in the stock market that are simply not comfortable with that type of risk. This has now become a very risky investment, whereas in the past, I wouldn't say it was a safe investment, but it was one where you had management basically playing it safe. They were generating cash flows, they were buying back the stock, they were just churning out results quarter over quarter. Now all of that comes into question. Now, when you come over here to the asset side of the balance sheet, you're going to see how this is going to get absolutely blown up. You just, again, did a $20 billion deal where about $10 billion is going to be in cash, the other half in stock. And you see here, in terms of our cash position after the most recent quarter, you have about, we'll call that $5.7 billion worth of cash. So this is a company that's just agreed to pay $10 billion cash for a company, and they have absolutely nowhere near that right now on the balance sheet. So there's probably some investors wondering where they're going to get that cash. They might have to tap the debt markets, where you had $3.6 billion in the most recent quarter. It looks like about $500 million rolled off onto the current side. So from an interest rate perspective, if they're going to have to finance this with a little bit of debt, well, those financing rates are probably going to be relatively steep, given the 2-year yield. I think people have been reminding me is about 4%, excuse me. So if Adobe's going to borrow $10 billion, it's probably going to be at an interest rate in excess of 4%. We'll see, though. Sometimes corporates can maneuver some better interest rates. Now, in terms of the cash flow, still a lot of things to like over at this company. Pulled down a net income number of $1.1 billion. Last year, you're at $1.2 billion. You add back in stock-based compensation, some other things, and you still get very beautiful cash flows over this company. For the last 3 months, you've got $1.7 billion worth of cash flow. Again, I don't want to sound like I'm repeating myself, but you can annualize a number out on positive cash flows, and you're still looking at just a massive price for the company that they just paid. Again, this is not Microsoft. This is not Apple. This is not Google paying $20 billion, where those companies literally could drop $20 billion out of their pocket, and I don't know if investors would even notice. Adobe doesn't even have anywhere close to $20 billion on the balance sheet. They don't have anywhere close to that from operating cash flows. This is a very steep price to pay. Now, they're continued to repurchase the stock. In the most recent quarter, they did $1.2 billion. Last year, about $1 billion. Now, when we get over here to the financial perspective, the technical perspective, it actually is setting up okay, I think, from a trading perspective. Now, I'm recording this on a Thursday. This would absolutely 100% not be a trade I would be looking to get in on Friday, which would be September 16th. This is something maybe you start looking at. I don't even think I would look at it into next week, because you're going to see what I'm talking about here. So Adobe's been in this downward channel, and I'm going to more clearly define these channel lines so I can kind of refer to them. The bottom channel line is going to be purple, and the top channel line we're going to change to, let's just change it to an orange color. As you can see, for many, many months now, the stock has actually acted like a lot of stocks that we've been looking at in this stock market. It's been in this downward channel, and all of a sudden, it just dumped out right out the bottom here. And now we're actually touching the bottom of the channel. I actually like to trade these types of setups. You can trade them both ways when you're at the top of the channel. If you want to go short, that is an area where you can. And then you set a stop loss just shortly above the channel. Same thing here. When you dump to the bottom of the channel, this obviously has been historically, just over the last couple of months, actually been a decent area to buy. I think it complicates the situation. The fact that, again, you have this $20 billion, and I showed you from a financial perspective how, this is like a teacher trying to go out and buy a Lambo. Like maybe it does happen, but it's kind of difficult from a financial perspective. So Adobe's probably going to pull it off. I quite frankly would await for the stock to show some kind of sign of reversal. A reversal would be basically just starting to put some green candles up and getting back towards the top of the channel. You can play this one maybe from the 315 range up to about the middle of the channel, 337. You get pretty strong upside on this one, and I would put a very tight stop loss on this one because, as you can see, the stock can move very closely. Now, that's from a trade perspective. I don't think a lot of you are watching this channel for that perspective. I would just say, to me, it looks like this channel is probably going to hold. I would say the vast majority of stocks that we're looking at, I don't know if they'll all dump out the bottom of the channel like this or dump to the bottom of the channel, but it looks like to me this stock probably is going to stay in this channel for a foreseeable future. We do have some areas of support, but they are a ways away. The most firm area of support is right here at about $260 per share. You could plus or minus, since it's $260, you can plus or minus probably 5% on a number like that. But it acted as resistance back in 2018, acted as support from 19 all the way into the March lows of 2020. This would be the area, if you want to go long Adobe, this would be the area where I would first want to step in, is right about that 260 level. Again, you probably, if you're starting a position, I am one here on the channel, obviously, if you know, and maybe I don't explain this well enough. When I say I would want to get into Adobe here at $260 per share, let's assume I wanted 10 shares of the company. I wouldn't buy all 10 right here, okay? I would buy, considering we have fractional shares, maybe start off with just doing a half a share or maybe one share at the most on the way down on this channel. And I would accumulate just a small amount of shares at this area because, again, if you break through now, if this channel just stays intact, and quite frankly, when we looked at these financials, the risk is this deal doesn't get integrated very well. Users of Figma maybe become picky and the existing ones leave and new ones don't come because maybe they don't want to deal with Adobe or the complexities that some Adobe software tends to have. Those are the risk, and that would continue you down this channel path. I think the best approach with Adobe, and this has been my approach for a long time with this company, is you take a kind of a wait and see approach. It is on your watch list. It is still relatively richly valued. We're going to have to deal with some share dilution over at this company, although they did talk about how the fact that, look, over the last year, you have reduced the number of shares outstanding, as you see evidence on the bottom of the operating statements. But obviously, that is probably going to change because they're not going to be able to offset that with enough share buybacks, to, at least in the shorter term. And I question, when we come over here and look at the balance sheet, how more upside down this is going to come, considering this company doesn't have anywhere near the cash to close on this deal. Now, the last thing that I didn't see a lot of talk about is from a regulatory perspective, Figma rolling up into Adobe. Certainly when we look at how active the FTC has been coming after Amazon and Apple and certainly Meta and Microsoft, they have been holding up deals with those companies all year, really over the last, it's been going on a long time in Washington, but the more recent deals that we've looked at have been getting held up. And I just question if Washington will just look past this because Adobe is not nearly the size of those other mega cap companies. But to me, it seems like this could be viewed as anti-competitive, although I did not see any terms of that or any really discussion of that. So I'm assuming maybe this deal will get the smooth sailing and it closes in rather short order. Adobe, not necessarily a cheap stock before, all of a sudden became mega risky, but that is your reward. If you know this space very well, you're very familiar with Figma, you're familiar with the customers of Figma, and you're comfortable with the fact that this company is going to continue to grow. Quite frankly, they need to grow basically at 100% clip for the next couple of years to get the price to sales multiple in a range where it actually makes sense. If you believe that is going to happen, Adobe's probably a stock that is going to absolutely soar in market cap and soar in value in the couple years ahead. But boy, they just layered on a ton of risk that a lot of investors decided to just cut loose today. We'll certainly keep tabs on this going forward. I'll try to get some more research on this. We'll give you some updates as we go forward with Adobe. I love high risk, high reward stocks. Wouldn't be something I center my entire portfolio out of, but Adobe all of a sudden turned from kind of a boring stock into one of those high risk, high reward stocks. And it might actually be more interesting today than it was before this acquisition. Hopefully, you guys have a wonderful day. We'll see you tomorrow for the Fang Stock Recap Show. Enjoy the rest of your day. Good luck with your investments.